Good morning, ladies and gentlemen. Well, the risk dial is firmly in risk on, absolutely no danger of a big catastrophic fall in equities. And as we can see when we have a look at how the present bull market is performing, it's absolutely within the normal standards, so nothing to be worried about. And really, the one thing that is very, very noticeable is the very low volatility that we're having from the technology sector. And since the tech sector is such an enormous weight in the indices, it basically says that until that changes, the odds of big drawdowns in equities are almost negligible. The big news of the week was the Waller speech, which made the markets get a huge bid. But really, let's analyze what Waller said, and I've included a link to the speech in the final frames of this video so you can read it for yourselves. He basically reminded us of what Powell said several months ago in response to a journalist's question at one of the presses of the FOMC. I forget which one it was. It's unimportant. Basically, he was asked why the dot plots for 2024 and 2025 had cuts penciled in. And it's important to remember that we are going to get a new set of dot plots in, 10 days' time when the FOMC meets again. What did Powell reply? Well, he basically said that unless they started cutting rates as inflation came down towards its target, and let's not forget that they have inflation coming down to 2% in 2025, then they would actually be tightening if they did nothing. Because as Fed funds stay at 532 effective and inflation comes down towards 2, then the real interest rate actually goes up. And therefore, conditions become more and more restrictive, which eventually would turn the economy into recession, because real rates above 3%, I don't think the economy can take. So basically, he said nothing new. He just reminded us of what Powell said and what everybody in the market, every professional, should know and have in the back of their mind all the time. It's just that when someone reminds you of something, you go, oh shit, and you panic a little bit. So this is the real, basically, interest rate. And we can see that from the beginning of the year, when we started the year here, it was 147. And now the real interest rate is, around 2, because this hasn't updated for a week. It'll be probably just below 2%. So we've had a tightening of, 30, 40 basis points in real terms. Now, if we look at the term premium, because this hasn't updated since November the 24th, it would be down at 0. So where did we start the year? We started the year here at, -6, -7. So we are within spitting distance of where we started the year. And if we look at the 5-year forward inflation expectations, where did we start the year? We started the year here at 220, 230. And where are we? We are at 232. Okay, so nothing has changed in terms of inflation expectations, term premium. The only thing that has happened is that the real interest rate has gone up over this period, and they want to cap it. They want to keep it at a reasonable level. What is a reasonable level? Who the hell knows? But 2% sounds about right. And since inflation has been coming down faster than they projected, they will probably change the dot plots. And remember, the dot plots are coming out in, what was it going to be, on the 13th or 14th? I forget now, immaterial. What are those dot plots going to show? Well, they are probably going to show that they are going to cut nowhere near as much as the market expects in the long term, in the short term rather, i.e. in the first half of 2024, but probably that they will need to accelerate those cuts to keep the real interest rate more or less constant and keep the, how shall I put it, keep the spread constant and therefore remain restrictive until inflation gets to target. Once inflation gets to target, then they can start bringing down the real interest rate to more normal levels around 1.25–1.5%. So this is going to be a process that is only going to be allowed by the market and by the Fed when the data allows it to happen. That is why I keep on saying we're more data dependent than ever, because we know what the Fed would like to do. The Fed would like at some stage to cut real interest rates back down into the ones, but they will only do that when it's safe to do that and the risks of a second wave of reaccelerating inflation have passed. So it's going to be a data-dependent path, and it's very obvious from everything every single Fed governor has said that that is their intention. Now, with this background in mind, let's have a look at where bond yields are throughout the curve and what is likely to happen in the next 2 weeks. Because it's important to remember that what happens next week is almost immaterial. What is really important is what the Fed dot plots are going to say next Wednesday or Thursday, whatever it is, and therefore how the market will react to those. Let's start with the 1 year. As you can see, it's definitely in a downtrend. But I think that there is zero chance that it's going to break 483 before the dot plots, and after the dot plots I would have thought it's going to be higher. It's probably going to be around the 520 area, and that is basically what I think is going to happen in the early part of next week, and probably through NFP it's going to try to go lower. And then when the dot plots come out and they can see that the Fed has penciled in probably zero cuts for 2024, because it costs them nothing, right? It costs them nothing to be hawkish for the early part or throughout the whole of 2024. It just reinforces their message that they are going to remain tight and have high real interest rates until inflation is at target. It costs them absolutely zero to do that. And in fact, it would be really counterproductive and stupid of them if they didn't do it. The more they persuade the market that they are going to be tight, the more inflation is likely to go down to their 2% target. And therefore, that is, I'm convinced that that is what they're going to do. They're going to really disappoint the market with their early dot plots and probably be realistic about what they can and cannot do in the very short term. So I would expect this to start, coming down towards these levels and then bounce to around the 520 area when the dot plots come out. And I think then that is probably a good area to actually start putting stuff on. Much the same kind of thing in twos. I think the likelihood of breaking below 442 is almost zero or if it does, it's going to go straight back up when the dot plots come out to around this 475 area, and that is probably going to be an excellent area to put stuff on for later on. 3s and 5s are actually my favored area because the belly will do, if the market is convinced, and I think it will be convinced, that they will keep rates tight until inflation is at target, then what do? You just give them time to achieve that. So 2s might be too soon. 1s probably are completely too soon. 2s might be too soon, but 3s, 5s, 3s, 4s, 5s, 6s, off the run stuff, definitely not. So those are my favored areas to get long on the pullback that's going to happen not next week, but the week after, once the market has seen and digested the dot plots. I think those dot plots are going to be absolutely key, and I would have thought that if you can see this kind of level in the 5s, 436 after the dot plots, you've got to shut your eyes and buy calls like crazy or get as long as you can, that kind of thing. I think the 3s and the 5s are going to move like shit off a shovel down towards this kind of level, into the 3s at some stage. I would leave the 10s and 30s well alone, because the 10s and 30s are going to be really subjected to a hell of a lot of issuance. Don't forget that next year we're going to have a record issuance of duration. And therefore, I think what's going to happen is that you're going to get a very funny looking yield curve, a U-shaped yield curve, that slowly transitions into a normal, positively sloping yield curve. So let's have a look at what that yield curve is going to look like. I would have thought 2s are not going to go a million miles away from where they are, but the yield curve is then going to do something like that. So 3s are going to come below 5s or at par with 5s, and 5s and the difference between 5s and 10s will be more pronounced than it is now, and it'll be probably from 3s or 4s outwards is going to be a positive curve, waiting for the 2s to catch up when inflation allows. And when it does, and it's probably going to be the middle or the second part of 2024, the 2s are going to come down and the whole curve is going to be positive. That is my long-term expectation. So let's have a look at what that would look like. 3s, 5s, I'm a seller of 3s, 5s. I don't think it can break up much. I think that we might get a last opportunity to sell 3s, 5s at around this level, around the 23, 25 area, when the dot plots come out. So I'm not going to do anything next week, but the week after, that is what I'm looking for. I'm looking for the market to get disappointed on these dot plots, and I think that that is going to be the last opportunity to put on 3s, 5s. Then 5s, 10s, I'm also a seller of, and I'm hoping that it doesn't break next week. That's what I'm hoping, and I'm hoping that it comes back up towards 0 or even 04, 05 when the dot plots come out, and that, I think, is going to be your last opportunity to sell the 5s, 10s. So if one looks at 3s, 10s, I think, again, if the dot plots say what I think they're going to say, you see this kind of area, 26, 27, and you sell the crap out of them. It's the belly, to me, is going to be from 3s to 5s, is the area that the market is going to buy with both hands once they see once they've digested the dot plots and they've got the meaning of it. Because again, the tighter they want to keep 2024, the better for the belly of the curve. Let's go on to Germany. And Germany, to me, is a new bull market in price. I really don't see that the European economy is very far from recession, and I think the ECB is going to have to probably act first at some stage. The longer they leave it, the better for the belly of the curve there as well. So Schatz, I think it's going to be very hard to break through these kind of levels, the 53 to 55 area in the next few days. And don't forget, the ECB is the day after, I believe, the day after the FOMC. So they're going to echo the FOMC. It's too early for them to go now, but the market will keep on pushing them. So any kind of a move back up in the Schatz to say these kind of levels, 78, 80, again an opportunity to sell it. But the one that I really love is the belly, the fives. I wish they had some threes or fours that I could trade in the futures. But this break, as I've been telling you all week, 245, 6, is to me a big signal. Where are we headed? I think we're headed to 212, a bounce back up to 245, and then a collapse. I really would not be surprised if in the middle of January, February, something like that, we were trading 175. Because as the data comes out and it shows more unemployment, worse PMIs, just the European economy just not doing very well, I think this 175 target in the bubble longer term is definitely on. I really can't see what's going to stop it. To me, the belly of the German curve is where you want to be. And if you look at something like 530s in Germany, I think any kind of move back up towards this 23 area after the dot plots in the US, because don't forget, Germany is going to react to 70% correlation or something like that with what the fives do in the US. Once you've seen that level, I think 530s starts coming down to these kind of levels. Again, the belly of the curve, that's the one you want to be in. And if you want something safer, 5s, 10s, I think with time that goes back down to these kind of levels, minus 26, something like that. That to me is the direction that things are going to be pushing towards, both in Germany and the US. One interesting chart that we haven't looked at before, this is Germany against Japan. And I think this is going to be significant for FX. I think it's going to break down. Japan is the one that's looking to tighten, if anything, while Germany is looking to ease a lot at some stage. To me, this level here at 153 is absolutely crucial. After that, we go down to these kind of levels, which is, a 60 basis point move. And even if we look at twos, I think over time, and not that long a period of time, we're going to go down to test this 223 area of a spread between Japan and Germany. So you're actually getting an FX euro yen kind of effect, and we'll look at that later. But I just thought I'd show you these two charts, and if you start watching them from now on, any kind of pullback after the dot plots in the US, and as I said, Germany will trade with a 70% similarity to what the US does. That will be your opportunity to jump all over it and walk away. Funnily enough, the dollar didn't do very much last week, And that is because there was almost a parallel shift between Germany and the US in terms of interest rate spreads. Now, what do I think about the dollar? I think the dollar is stuck. I think that until Germany starts getting a lead over the US dollar in terms of when they start cutting, it's really not going to move much higher than this 104.40 level. I really don't see that there is very much to do in the Dixie but play this range between this, 102 area and this 104, 104 and a half area. That is all I can see in the dollar for the time being. But the one that is going to become interesting is the euro against the yen. As I showed you in those interest rate differentials, I think that we test this 158 level, we bounce off it, probably back up to 162 or something like that, and then at some stage we break down, and we break down hard, and we come down to these levels, which is like 147. I know this is a very, very volatile spread cross, but I think it's going to be worthwhile for us to start watching it. I really wouldn't sell it below 158 at the moment. I think that is going to be very, very good support until after the Fed dot plots. And I'm hoping that this has the same behavior as what I expect to have from the interest rate complex, because I do think the Fed dot plots are going to disappoint everyone that's, jumping the gun and saying, yeah, we're going to have a huge rally in bonds immediately. I think that that is very unlikely to happen. I think they're much more likely to be very, very disappointed by how hawkish the Fed is in its dot plots for 2024. And therefore you get this reaction back up, and then you are ready to fall. That is what I'm hoping for. We'll see, but certainly the direction of travel from now on for euro yen should be south, just as the direction of the interest rate spread between the two should be south. Before I go onto the outright price of gold, I wanted to show you this chart, which is TLT over GLD. And basically this dismantles the argument that gold is doing anything at all. It's trading with bonds. That's what it's doing, nothing more. Okay, having established that it's doing absolutely bugger all, let's have a look where the resistance is. To me, this 2140 level is natural resistance, and we will be through the weekly Bollinger Bands and everything. But since bonds closed so strong on Friday, and everyone will be falling over themselves to lower their NFP estimates as much as possible, it's perfectly normal for bonds to go up, 0.5% to 1%, i.e. down 4, 5, 6, 7 basis points before the NFP comes out, and therefore it's perfectly reasonable to expect that we're going to trade 2140 in gold. But just as I expect bonds to come back after the dot plots, I expect gold to come back after the dot plots. And where is support? 2045, and then the 200-day moving average around the 2010 area. That is what I expect gold to do, i.e. continue trading with bonds and really have no moves of its own. The one that just can't get up off its arse is DBC. And every time it gets to this 2439, it just, comes down. It's significant to me that we are basically at the same level as, or a couple of percent lower as where we opened the year. And if you go back to the beginning of this video and you have a look where real interest rates are and where the 5-year forward is of inflation expectations, etc., you will see that we are in everything more or less where we started the year, even in the yields of certain tenures in the bond market. And that tells you something. That tells you that we are very unlikely to move much higher. And really, the danger is beginning to be to the downside, and which is eventually going to be very, very good indeed for bonds. I don't think it happens immediately because you can see from these weekly Bollinger Bands how tight we are getting. It just means that in 2-3 weeks' time, we'll be ready to break out one way or the other. And the one way seems to be down as opposed to up. Now, what is also very interesting to me is that we are in gold DBC, we're beginning to break out. And if we start breaking above this previous high, that will be very, very good for bonds. Extremely good for bonds, especially if that means that DBC is coming back down to the lows and gold trades with bonds, as I showed you, and therefore that will be very, very good for bonds, and we will probably be going up to, I don't know, these kinds of levels. And that's going to be a big move. A big move for bonds, probably, possibly a big move for commodities back down to test these levels around 21.75. So that's another 10%. So you can see that we are getting the signs, the first signs that really inflation might get to target faster than the Fed expects, and bearish FOMC dots are possibly the last chance to get on board of the bull train in bonds. Before we have a look at the individual indices, I think this is interesting. This is IWM over NDX, and we're getting the first signs of a break up in that spread. Why would they be breaking up? And I love to triangulate, you know that. IWM is very heavy with financials. And what do financials love? Financials love a positive yield curve that they can just ride. And I think this is the first signs of the equity markets anticipating the disinversion of the curve and a positively sloping yield curve that financial institutions can ride again. Why did last week NDX do absolutely nothing? I think it's rotation. I think there's been an awful lot of rotation into the Dow Jones, which is also financials heavy. Don't forget, it's got things like JP Morgan, Visa, other banks, etc. So there was a lot of rotation into the, let's have a look at IWM against the Dow Jones. As you can see, didn't do much. It's going up, but it went up considerably more against the NDX. So last week was a week of rotation as opposed to a week of price direction. And I think that that is what the equity markets are anticipating, a positively sloped yield curve. I just want to show you that just like gold is trading with bonds, so are equities. And there's absolutely no reason to expect that this is going to break down hard. You know, it's going to just faff around. So to me, when you're trading bonds at the moment, you are trading effectively stocks. And until you start getting some real data which shows that the economy is rapidly deteriorating, that is likely to remain the case. I just don't see how we're going to start moving very hard up or very hard down without something changing in the speed at which the employment situation is deteriorating. This very slow drip, 1,000 here, 2,000 there, just isn't going to do it. It has to be an acceleration in the unemployment. And is it likely to happen in the next month? No, I would say no. You know, who's going to start making these decisions just before Christmas? The earliest you could start seeing it is in January, February, March. So really, I don't think very much is going to change in this spread relationship. And that is what the risk dial actually tells you, that it's going to be a long time before we start seeing risk off. The correlation between bonds and stocks is still almost one. So you're trading the same thing. What do I think is going to happen? I think that before the NFP or on NFP or whatever, we're going to have a spike up to this 46 INX level, possibly even a little bit higher, possibly even to 47.12. But I think from there, everybody is going to be long, and he backs off after or into the Fed dot plots. And I think that that is going to be yet another buying opportunity. But, you know, 1 week at a time, there's no need to anticipate. I certainly don't see any kind of pressure on stocks next week. And really, the most important level that I can see here is this, I'll enlarge it for you, is this level of 45, 42 that we could never break. You know, we tried to trade below it, but we never closed below it. To me, it's very, very important. As soon as it breaks down, I will start looking at as to why. But I think it only goes down to something like 44.80. So I still see this going up, this getting to very overbought levels. You know, whether it's here or here, I have no idea. But in this kind of area, I think the risk reward is to be flat and then wait for the pullback on the disappointment that we are likely to get from the dot plots, and then possibly go again. Leadership in the Nikkei is beginning to wane. I really don't see that Nikkei is going to outperform other markets at the moment. And I would have thought that actually deploying some cash out of, and I mean some, I don't mean everything, out of Nikkei and possibly into Europe is not a bad idea. I like Europe. I don't think that it's going to be a massive leader, but I think that any market where we are anticipating cuts is likely to outperform a market which is, and let's go back to Nikkei, which is anticipating nothing or hikes or tightening, let's put it that way, of financial conditions. I think it's very unlikely that in the next, 4 to 6 weeks, we get outperformance from the Nikkei, unless I'm very badly wrong about what is happening in the differential between the Japan and Europe, and if I'm very badly wrong as to the forex implications of euro on euro yen. So I'm more tempted than not to sell rallies in the Nikkei now and start buying some European equities with the money and or US equities. I think those are beginning to be better bets at the moment. Since we've started a new month, it's interesting to always have a look at what the monthly candle charts show, and if I enlarge it, basically this is the level that I'm looking for, 47.64, and that's the highest monthly close we have had. We hardly ever break through the Bollinger Bands on the monthlies without coming back and testing them. So risk reward says you definitely, if you see it 47, 64, you want to be, flattish, or you want to lighten up, because even if it's going up, it'll come and retest it. So a lot of people are getting very excited. I do expect it to trade somewhere around here, because it would be rude not to, kind of thing. What's that? 46.90 is just 4700-ish. Be rude not to, as it were, because you don't want to disappoint too many people. If you look at NQ, here we go. So the high close actually on the monthly is 16,300 and something. Who cares? Definitely we'll try it at some stage. And NQ has got more room to the upside from the Bollinger Bands and the others. Who knows if it'll take the opportunity. Maybe, after Christmas in 1 week, it'll do a huge spurt back up to, nearly 17,000. And YM, this is the highest monthly close, 36,340. Given what I think the belly of the curve is likely to do after the dot plots, I expect this one to start breaking and achieving the all-time high, which is going to be somewhere around the 37,000. So absolutely nothing bearish on any of the monthlies. It's certainly got a couple of percent that it can go up, but don't get overexcited when it gets over the monthlies, because it always comes back and retests. I've updated all the levels, and I've included the link here for Waller's speech, and I think it's important that you should read it. A lot of stuff has been reported about it. I'm telling you what it didn't say. It didn't say anything new. It just reminded people of what is A, obvious, and B, Powell has said not once but many times, and which makes perfect sense. I mean, why would they want real interest rates to go above 2.5%? It's restrictive enough as it is, and it seems to be having an effect. The last thing they want to do is cause a recession, and therefore it makes perfect sense that if you triangulate everything, the belly of the curve is going to be the place where you want to be after the disappointment of the dot plots. So whether you get in now or you get in after the dot plots, I think, if you're patient, you're going to see some very nice returns in that 3 to 5 year area in the US and especially in Europe. Thank you very much indeed, and tweet you tomorrow.